This is the beginning of part 3 of our module on convertible instruments, which discusses the mechanics, pricing, and some regulatory and accounting aspects of mainstream convertible instruments. We remind you that this part 3 contains chapters 5 and 6 of the module, with chapter 5 analyzing the impact convertible bonds have on an issuer's balance sheet, leverage ratios, earnings per share calculations, and other metrics from the accounting, regulatory, and ratings perspective, and chapter 6 containing the final quiz. In this chapter 5, we will limit our discussion to regular and mandatory convertibles and will ignore reverse convertibles, since these are such a small minority of the universe. It is critical to make a caveat we always make when discussing these types of disciplines in our modules. If you have heard this caveat before, skip the next 2 minutes of this commentary. Accounting and regulatory standards are different in different geographies, may apply differently to different entities based on their identity and legal form, are constantly being amended or even revamped entirely, and often allow the user to choose among several alternative approaches and to exercise significant judgment in the application and interpretation of the standard. Similarly, rating agency perspectives may often differ among S&P, Moody's, and Fitch, and also evolve rapidly over time as new products come along and new data and experience is collected. Finally, a small change in facts or market conditions may give rise to substantially different answers in each of these disciplines. Therefore, it is not possible to teach the exact letter of accounting or regulatory guidelines or of rating agency criteria, nor would it be useful to you if we attempted to do so. We can, at best, aspire to help you understand thoroughly the nature of the questions and issues that focus the minds of the practitioners in each of those disciplines. Describe in broad terms the approaches used to analyze the situation in question, and leave you hopefully able to apply what you have learned to interact more effectively with qualified specialists in each of these disciplines. We will, in each case, deal only with the most important issues and not attempt a comprehensive review of all relevant questions. The principal issues that relate to convertible instruments in the accounting arena from the issuer's perspective first are: 1, whether to count the instrument as debt, equity, or some combination thereof on the balance sheet, and 2, whether to take the underlying shares into account when calculating profitability metrics such as earnings per share or EPS. U.S. accounting typically treats a regular convertible as 100% debt until the time it converts, no matter how far in the money the conversion option may be. It is felt that the share price is always at risk of declining below the strike of the embedded call option, with the issuer therefore finding himself all of a sudden obligated to repay in cash the bond when it matures, possibly only days after it had looked almost certain that conversion would occur. The conservative treatment, therefore, is to view the instrument as a liability until it has legally converted into common stock. U.S. accounting also requires the publication of two earnings per share numbers, a so-called simple one, which reflects only those shares that are outstanding already, and a fully diluted one that reflects also contingent shares under convertibles and other hybrids. Only the fully diluted EPS calculation takes into account the common shares that will be issued upon conversion of our regular convertible, and even then only in limited circumstances when the conversion option is relatively likely to be exercised, as measured under a very technical quantitative test we will not describe. When this test triggers this requirement, however, fully diluted EPS is defined as net income after tax plus some amount of interest we'll discuss in a second, divided by, as you can see, the total number of shares including the new ones upon conversion. The idea behind this is to alert the reader of the financials that in addition to existing shareholders who are, of course, entitled to share among themselves the company's total profits after tax, a supplementary class, if you like, of shareholders will come into existence if the convertible converts. And these new shareholders will cause dilution of the existing ones by claiming their appropriate share of these profits after tax. However, to avoid making this EPS calculation too punitive, the interest accruing in the reporting period under the convertible would clearly no longer accrue if the instrument converts. So it is only fair to add it back to the numerator of the calculation, but only on an after-tax basis, since interest is tax deductible. If the previous sentence was a mouthful and hard for you to follow, please pause and review it until you are comfortable with it. But in any event, the following numerical example hopefully will make it all quite clear. The relevant data is set forth in the table below. So a $20 spot for the stock, 1 million shares of common outstanding, net income is $1 million, and the company has $1 million face value of convertible, paying a coupon of 3% when the company is in a 50% marginal tax rate. And finally, the convertible stipulates a conversion price of $25, which essentially means 40,000 shares will be issued if the convertible converts. In this example, the simple EPS is calculated as net income after tax over shares outstanding, and that's just 1 million over 1 million, so it's $1 per share. Whereas the fully diluted EPS is calculated, as we know, as this complex formula, which is therefore the million adjusted upward by the after-tax interest cost divided by the million shares, but adjusted for the dilution, which becomes $0.976 per share. So we can see the dilution impact, and it is reasonably significant here, and of course it can be far more significant in certain cases. IFRS brings up an important difference from US accounting with respect to the characterization of regular convertibles on the balance sheet. Instead of treating the entire instrument as debt from the issuer's perspective, IFRS requires its bifurcation into two separate components, pretty much as we did when we decomposed the instrument into a discount bond and an equity call option for purposes of valuing it. The discount bond appears as debt on the issuer's balance sheet, while the equity option appears in the equity account. This means, of course, that the issuer's leverage ratios would appear lower under IFRS than under US GAAP. Bank regulators follow an approach that runs somewhat parallel to the US GAAP approach. Regular convertibles are debt on the balance sheet, so increased leverage even if the option has gone deep in the money. Mandatories, however, are equity for capital purposes, and in some cases even Tier 1 capital, depending on the extent of the issuer's obligation to pay the preferred dividend. Distressed banks that are under pressure from their regulators to raise capital urgently, but unhappy about issuing common shares at such low prices, find these types of mandatories especially attractive for their ability to reduce dilution if the bank's share price ends up soaring once the present difficulties are over. In one of the most famous examples of this kind, Citicorp, as it was then known, issued a mandatory like this in 1991 to bring up its Tier 1 capital ratio to the minimum 4% required under Basle I at that time. The instrument offered low double-digit dividends and converted in 3 years into common shares, but placed a cap on the investor's IRR at somewhere around 22%, which corresponded to a common stock price some 30% above the level on the issue date. In fact, the stock proceeded to rise over the next 3 years by around 500%, which would have implied an IRR of around 81% for common shareholders. The mandatory instrument reached its IRR cap within a few months after it was issued, and its holders, of course, watched in some dismay as their 22% return fell behind that of the common stockholders by almost 60% annualized. Rating agencies have typically shied away from granting equity credit to regular convertibles prior to their conversion, again on the basis that the risk of a crash in the stock price can never be ignored, and therefore that a conservative approach is more appropriate. Mandatories, of course, are a different matter and generate in all cases some partial equity credit at least. The amount of equity credit may differ in some cases depending on the extent of the obligation to pay dividends and whether these dividends must be paid in cash in all cases, but is invariably significant and able typically to improve leverage ratios rather than make them worse. The concept of a rating agency equity credit will be discussed extensively in our advanced modules on hybrids, including the famous hybrids that achieve equity credit from the ratings perspective while remaining tax deductible under tax regulations. Investors under both U.S. and international accounting are required to bifurcate a regular convertible into a bond and an equity option, and then proceed with the accounting treatment of each separately. Thus, while the bond may be held to maturity, available for sale, or as a third option considered part of a trading position, and then accounted for in accordance with the applicable rules for each of these three alternatives, the option would be classified as a derivative in the great majority of cases, and thus recorded at fair value on the balance sheet, with changes in this fair value between one period and the next passing through the income statement. We are assuming that the option cannot qualify as a hedge for the investor, which will be true in the great majority of cases. Regulated investors are too varied and subject to too many different regulatory regimes to enable any useful summary of how their investments in convertibles are treated for regulatory purposes. But we will content ourselves with saying that in at least a few cases, convertibles have enabled some investors to acquire exposure to desired equities or equity indices while relying on the initial legal form of the instrument as a bond to argue for a substantially lower capital requirement. This completes our brief discussion of important issues under accounting, regulation, and rating agency methodology.